As we head into the fourth quarter, some economists are expecting some softness. I'm joined by Anthony Chan, the chief economist at JPMorgan Chase. And Anthony, welcome back. It's great to see you here.
Glad to be here.
So we had a very strong second quarter GDP rating last Friday, up 3.9%, but the outlook for fourth quarter isn't as bright.
It is not as bright, but it's still a respectable number. We're looking at something in the neighborhood of about 2.5%. Remember that in the third quarter, we'll also see some inventory corrections. So the strong number we got for the second quarter will be a lot weaker in the third quarter, perhaps inventory subtracting 1% or even a little bit more, and then a little bit of a recovery in the fourth quarter, but certainly nothing compared to that second quarter.
Or the fourth quarter of last year.
Oh, absolutely. Traditionally and historically, the fourth quarter has been a strong number. This year, we've adjusted the seasonal factors. And so the strength that we gave to the economy in the first quarter because of weather conditions has to come out of the other quarters during the year.
All right, let's talk about inflation. We just got the latest reading on core personal consumption expenditures this morning, up 1.3% over the past year as of August, compared to a 1.2% increase back in July. What does this mean in terms of the Fed? I mean, they still say they're reasonably confident that inflation will move back towards its 2% target gradually.
Well, here the Fed certainly is caught between a rock and a hard place because the economy is doing very well. The employment mandate and the growth mandate in itself is doing fine. But on the price front, things are a little bit soggy. But keep in mind that we are inching towards that 2% target. When you look at that core PCE at 1.3%, a little bit stronger than the prior month, it gives the Federal Reserve at least some of the wherewithal to say that they could be reasonably confident that they're moving towards that mandate. And given that monetary policy has these long and variable lags, they can't wait until they hit that 2% target before moving.
Because if they do, I mean, we're talking a rate hike several years away instead of this year, because it's going to be quite some time before we see that core PCE back towards 2%.
I mean, you're absolutely spot on. And in fact, Janet Yellen herself indicated that it would probably take 2 to 3 years to reach that price mandate. So they are not going to be able to wait with unemployment rates coming down and, in fact, moving towards that 4% handle in the not too distant future. They will have to move before then.
So in terms of the timing of a rate hike, are you in the December camp?
I've been in the December camp for quite some time. I was never in the September camp. And in fact, Janet Yellen indicated that both her and the rest of the committee are pretty convinced that they have to move sometime before the end of the year. And I think that moving in October is still too close to September when they decided not to. But September definitely is one of the best odds if you're going to bet as to when they're going to go.
Although December, in terms of the market expectation, those probabilities have been coming down, certainly since before the September meeting.
Well, I think those probabilities are low, but as more and more data comes through, and in fact, Friday we're going to get another employment report, and I expect that number to be closer to 225,000, again, continuing to tighten that labor market. I think as we approach December, the odds will start to increase for the market.
All right, Anthony Chan from JPMorgan Chase. We'll leave it right there. Thanks very much for coming in.
A pleasure.
I'm Scott Gamm, and you're watching The Street.